Hello everyone and welcome to BDO's International Tax webinar. Today's subject is transfer pricing. Just a few housekeeping points before we get started. Today's webinar is using audio broadcast technology. That means you should be able to hear the webinar through the speakers on your laptop. However, we do sometimes hear that people are having trouble with the audio if they are dialing in from a place where the broadband connection isn't that strong. So if that is the case, then please do feel free to dial in using a telephone line. If you click on the telephone button symbol on the right-hand side of your screen and follow the instructions, you'll be able to dial in using one of the designated telephone lines. We are offering CPE accreditation, particularly for those of you who are in the US and require CPE certificates to be issued. Then you'll need to follow dial in for the whole of the webinar and respond to at least 75% of the polling questions that will pop up from time to time throughout the webinar. We do have 5 polling questions today, so they'll be popping up approximately every 10 minutes or so, so please do watch out for those on the right-hand side of the screen, answer the questions, and the CPE certificates will be issued after the event. Special rules apply for those of you who are participating in groups. There are more details on the slide. We also have a Q&A facility on the webinar. If you want to ask a question, then please click on the Q&A section of the webinar on the right-hand side of the screen. If you address the questions to all panelists, then we will attempt to answer the questions as we go through the webinar. If we don't have time to answer the questions during the webinar, then we will respond after the webinar has completed. We will also allow a few minutes at the end of the webinar today to answer questions that have come up throughout the webinar, so please do send us the questions as we go through. So I'd just like to introduce the team today. My name is Malcolm Joy. I'll be hosting the webinar. I'm a tax partner in the London office in the UK, head of transfer pricing in the UK, and very pleased to be welcoming 3 of my transfer pricing colleagues from around the world. First of all, we have Ilona Orbuk, who is head of transfer pricing at BDO in Hungary. We have Paul Daly, who is transfer pricing partner here in the UK, and have Mark Shutty, who is the head of transfer pricing at BDO in the US. The agenda for today is, following a brief introduction from myself, Ilona will talk about recent developments in the world of transfer pricing. Mark will then move on to talk through some of the latest thinking on the documentation requirements for transfer pricing. And then Paul will finish off today's webinar by looking at how groups are managing their transfer pricing compliance requirements, with a particular focus on the use of technology, which is something we are seeing more and more of. Just a few words from myself to introduce the session today. Transfer pricing is always a very popular topic for these webinars, and since the BEPS papers were released in 2015, we've had a variety of changes coming through, mainly in the OECD transfer pricing guidelines. And these changes are affecting how companies price and document their intragroup transactions. And although we see a lot of consensus amongst tax authorities as to how these transfer pricing changes take place and what those changes will be, there are important differences both in the timing of the implementation of the changes and also the requirements for how groups report on transfer pricing in the new regime. So Ilona, Mark and Paul will talk us through the recent developments and also best practice for how to deal with those changes in the current world of transfer pricing. I'm going to start with Ilona. So Ilona, if I could just hand over to you and let you talk us through some of the recent changes that we've seen over the last 6 to 12 months in the world of transfer pricing.
Good morning and good afternoon to everyone. I would like to talk about the recent developments in relation to transfer pricing. In order to understand the new developments, let's see the background first. One of the effects of globalization is that companies are increasingly expanding and are becoming more and more represented all over the world. The national tax laws have a hard time keeping up with this huge expansion and with the flow of capital. Therefore, MNEs had the opportunity to place and keep their profits in low-tax jurisdictions by making use of the loopholes in taxation. This trend has reached such a high measure that also major economic organizations have begun to deal with this issue. Thus, the finance ministers of the G20 countries have requested the OECD to come up with an action plan against aggressive tax planning and tax evasion. Therefore, in 2013, the OECD has developed a 15-point plan called BEPS, Base Erosion and Profit Shifting. BEPS refers to tax avoidance strategies that exploit gaps and mismatches in tax rules to artificially shift profits to low or non-tax locations. As a result, there were a number of developments from the OECD side. Now let me summarize the recent ones in relation to transfer pricing. In July 2017, the OECD released a new edition of the OECD Transfer Pricing Guidelines for multinational enterprises and tax administrations. This edition mainly reflects a consolidation of the changes resulting from the BEPS project, such as guidance on safe harbors, value creation, and transfer pricing documentation. Additionally, there is an updated guidance on the implementation of country-by-country reporting, which we will cover later. OECD has also published draft discussion drafts on attribution of profits to permanent establishments and transactional profit splits. The PE report indicated that there is also a need to take account of the results of the work on other parts of the BEPS Action Plan dealing with transfer pricing. In particular, the work related to intangibles, risk, and capital. Regarding the profit split method, the revised draft is intended to clarify the application of the transactional profit split method. In particular, by identifying indicators for its use as the most appropriate transfer pricing method, and providing additional guidance on determining the profits to be split. Another development is a toolkit that has been introduced to help developing countries address the lack of comparable for transfer pricing analysis. The toolkit is part of a series of reports to help developing countries design or administer strong tax systems. Furthermore, the BEPS project initiated a discussion draft on the implementation guidance on hard-to-value intangibles. The discussion draft demonstrates the principles that should underline the implementation of the approach to hard-to-value intangible and addresses the interaction between the approach to hard-to-value intangible and the mutual agreement procedure under an applicable treaty. And finally, the OECD released the first peer reviews on implementation of BEPS minimum standards on improving tax dispute resolution mechanism. A key pillar of the project focused on improving the mutual agreement procedure, which resulted in a new minimum standard to ensure that tax treaty-related disputes are resolved in a timely, effective, and efficient manner. Now I would like to introduce you the new OECD transfer pricing documentation requirements that have changed significantly. Previously, the OECD guidelines did not provide for a list of documents to be included in a transfer pricing documentation package, nor did it provide clear guidance with respect to the link between the process for documenting transfer pricing, the administration of penalties, and the burden of proof. Since then, many countries have adopted transfer pricing documentation rules, combined with a dramatic increase in the volume and the complexity of international intragroup trade and the increased scrutiny of transfer pricing issues by tax administrations. Consequently, the OECD transfer pricing guidelines identified 3 objectives of transfer pricing documentation rules. The first one is to ensure that taxpayers give appropriate consideration to transfer pricing requirements in establishing prices and other conditions for transactions between related parties and in reporting the income derived from such transactions in their tax returns. The second identified goal is to provide tax administrations with the information necessary to conduct an informed transfer pricing risk assessment. And finally, to provide tax administrations with useful information to employ in conducting an appropriate audit of the transfer pricing practices of entities subject to tax in their jurisdiction. In order to achieve these three objectives, the OECD has introduced three-tiered transfer pricing documentation structure that countries should adopt. According to the structure, M&E should prepare as a first pillar a master file that provides an overview of the M&E Group business, including the nature of its global business operations, its overall transfer pricing policies, and its global allocation of income and economic activity in order to assist tax administrations in evaluating the presence of significant transfer pricing risk. In contrast to the master file, which provides a high-level overview, the local file provides more detailed information relating to specific intercompany transactions. The local file focuses on information relevant to the transfer pricing analysis related to transactions taking place between local country affiliates and associated enterprises in different countries. And the third pillar is the country-by-country report, CBCR, which is a very new element of the transfer pricing documentation structure. It requires aggregate tax jurisdiction-wide information relating to the global allocation of the income, the taxes paid, and certain indicators of the location of economic activity among tax jurisdictions in which the M&E Group operates. As CBCR is a new element, let's see who is obliged to prepare the report according to the OECD guidelines. M&E groups with annual consolidated group revenue of more than 750 million euro, or near equivalent amount in domestic currency, as of January 2015, should prepare CBCR. It is recommended that the first country-by-country reports are filed for M&E fiscal years beginning on or after 1st January 2016. This recommendation means that the first country-by-country reports would be filed by 31st December 2017. The OECD identified several data that should be reported. Let's see the main ones. Revenue data from related and third parties, as well as total revenue, profit before tax, corporate income tax paid, stated capital, tangible fixed assets, and employees. Regarding the penalty regime, they are governed by the laws of each individual country. Based on the CBCR rules introduced recently, there will be high penalties in several jurisdictions. CBCR implementation guidance and rules have been published in several countries recently, for instance in Argentina, in the USA, and so on. Rules and guidance include definitions such as ultimate parent companies of the M&Es, which entity is obliged to report, annual turnover threshold, currency exchanges, deadlines, and notification to tax authorities. Let's see some recent international examples. In Hong Kong, the Inland Revenue will issue guidance to assist in understanding the new rules, which will include mandatory TP documentation measures after a certain threshold met, domestic transactions to be included in the regime, specific provisions on IP, and penalty regime. Ireland plans to implement new transfer pricing regime and changes for intangible assets by 2020. They will extend the scope of TP regime to non-trading, domestic and cross-border transactions, aiming to reduce risk of aggressive tax planning and mismatches. There will be reporting requirement in Spain for periods beginning 1st January 2016 on transactions with related parties, countries as tax havens, and transactions where the revenues from certain intangible assets under the patent box regime are reduced. In Australia, the Australian Tax Office has completed over 1,000 reviews and audits in a range of sectors, which proves that additional level of resourcing they have taken on. In the United Kingdom, headline statistics show that there has been a 90% increase in transfer pricing adjustments over the prior year. Given the high level of ongoing inquiries and the introduction of the CBCR, it is predicted to continue. Based on the aforementioned, we can see that many countries have adopted CBCR recommendations into their local transfer pricing rules, and tax administrations are also prepared in assessing the CBCR requirements. Consequently, increased scrutiny by tax authorities is expected from OECD member countries. Therefore, M&A should understand and examine the consequences of the new requirements for each jurisdiction in which they operate, and they should review the amendments of the OECD transfer pricing guidelines with respect to their global operations and their current transfer pricing policies and approaches. To summarize, there will be a whole new world regarding transfer pricing documentation requirements that M&A should be aware of, and BDO is willing to help. Thank you.
Thank you, Ilona, for that overview on recent developments. One of the recent developments that we've seen coming out of the OECD has been around the use of profit splits. And in the past, profit splits haven't been used that often as a method of allocating profits between tax jurisdictions. And I think the OECD's recommendation in the past has been that they should only be used in a very narrow set of circumstances. But given the big picture aim of BEPS is to try and ensure profits are taxed where the value is created, I'm just wondering, do you think we're going to see a greater use of profit splits in the future as a method of allocating profits between countries?
So, in the past, profit split method has been used under the circumstances where both parties contributed unique and valuable intangibles, or businesses are highly integrated. Intuitively, with BEPS, I would expect greater use of profit splits, but my sense is there is still a lot of resistance out there. The fact that we are still consulting on profit splits could suggest that OECD has been struggling with this. So perhaps we will see greater use of them as some kind of secondary approach to support transfer pricing policy.
Okay. And also we've got the consultation that's happening around the attribution of profits to permanent establishments, and that's something, again, that the OECD have pushed out there for the public to comment on. I guess that now that we've got a new definition of permanent establishment, which is being implemented for many countries, although not all, through the multilateral instrument that's being pushed out, then does that mean that we're going to see a lot more of activity around permanent establishments, people having to report permanent establishments where they didn't have permanent establishments in the past? And do you think it's likely that tax authorities around the world are going to aggressively pursue this area and look to attribute profits to those permanent establishments?
Well, we could see quite a diverse approach for a while, I think. There are some countries, such as UK and Australia, who have brought out separate legislation to deal with aggressive forms of artificial avoidance of PE. So, arguably, they may not focus on this area too much. I would say that other countries may be more enthusiastic.
Okay. Yeah, no, I think that's something we recognise in the UK, where I think the UK tax authorities are reluctant to have taxpayers declare a whole load of extra permanent establishments but have very little in the way of profits attributed to them, as that would just cause a lot of bureaucracy for them. So yeah, I certainly think that in the UK the view is that the more aggressive forms of tax avoidance through avoiding a BE are being dealt with through the diverted profits tax. So hopefully that won't cause too much extra work for taxpayers. But just a final question before we move on to the next section with Mark. The Chevron case, which was on your slides there, which is a very major case in Australia, been creating an awful lot of interest in the transfer pricing community, particularly since the Australian Tax Office announced that they thought the Chevron case and the findings in that would result in an extra $10 billion of tax revenue for the Australian government over the next 10 years. Are you able to just tell us a little bit more about the Chevron case and comment on whether or not you think that other tax authorities will be encouraged to mount similar challenges?
Yes. The Chevron case concerns the transfer pricing implication of an intercompany loan agreement between, as you mentioned, in Chevron Australia and its U.S. subsidiary, and whether the interest paid by Chevron Australia to Chevron U.S. exceeded an arm's length price for the borrowing. The federal court ruled that Chevron was liable for $340 million in unpaid taxes related to, as I mentioned, intercompany loans. Finally, Chevron Australia lost full federal court appeal. I think that this case could also have implications globally, as it is one of the most significant cases on related party financing and transfer pricing. Chevron case shows the importance of properly analyzing, documenting, and evidencing intragroup funding transactions. In light of this decision, I think that taxpayers should assess both historic and future related party arrangements and identify specific transactions which may represent a potential risk, as transfer pricing audits are most likely to increase in other jurisdictions as well.
Okay, and just big picture, the Chevron case, what was happening there was Chevron were borrowing externally at a group level at quite a low rate because of the security that they could provide, given the size of their group. But then Chevron Australia was borrowing from the US at a much higher rate of interest, and the arguments that were being put forward there were that that was still an arm's length rate for the Australian entity on its own, given the lower level of security the Australian entity could provide. So really the case was all about to what extent there were some kind of implicit guarantees or security provided by the wider group for Chevron. I think it opens up quite a difficult set of questions for taxpayers to deal with when looking at intragroup borrowing. But thank you very much for that, Ilona. We're now going to move on to Mark, who's going to talk us through the BEPS Action 13 and the latest on the specific documentation requirements that have come out as a result of BEPS Action 13. So Mark, over to you.
All right, thank you, Malcolm. Yeah, I'm going to focus my comments on Action Item 13, which deals with the three-tiered documentation guidance that Ilona went through in her section. If we look at pre-BEPS, a lot of times companies were able to really just focus on documenting the transactions that occurred within their local country, and as a result, there was limited transparency on how the company operated globally. They were able to do just single reports and very often reports done by different advisors in local countries, which led to a lot of times very inconsistent positions being taken country by country. It also was typically a one-sided analysis, so there wasn't a need to look at the global picture, but just really the results of that local entity. Post-BEPS and with this Action 13 guidance in place, what we're seeing now is with the country by country and the master file, all of this information is going to be provided to each of the countries, which really is going to provide a lot more transparency as to how these local entities fit into the global supply chain. I think most practitioners think that once this is in place, it's going to lead to the local authorities really seeking a larger share of the global profit. I think they will have a view of the global profit that they never had before, and I think most folks think that's going to lead to a lot more controversy. The other change that I think we'll see is going from one-sided analysis to more of a value chain analysis where the relative value of the contributions that each country makes would be considered, as well as we talked about profit splits. I think you're going to see taxing authorities push for a profit split method, looking at the splitting up the global profit more under this guidance. So where are we? 2016 is really going to be a transition year into 2017, and so countries have not adopted all of this uniformly, where some countries have adopted all 3 tiers and require companies to provide that. Companies like the U.S. have only adopted the country-by-country report. Other differences, you have countries like China that requires this value chain analysis as part of its local file, and then many countries in Latin America actually require you to file the transfer pricing documentation as part of the tax return, as opposed to something that is maintained in the company's files. As far as just statistics on where the countries are on country-by-country reporting, as of September, there were 55 jurisdictions that had adopted CBC reporting into their local legislation. Over 65 had signed the multilateral agreement, and that's the agreement that allows for automatic exchange of CBC data. The U.S. Notably has decided not to be part of that process, and they are doing it on a country-by-country basis. So as of September, there were 20 bilateral competent authority agreements that the U.S. had negotiated with separate countries, and they were negotiating another 20 more. So some practical considerations on, I guess, each of these tiers that we see here, master file, local file, and country by country. Starting with the master file, when we talk to companies about having this requirement of having to do a master file now, which is typically something new for companies, it wasn't a requirement there before. It's really your chance to tell the taxing authorities your story. It needs to, I think the additional task that you have is it needs to be consistent with your local documentation. So if you have had a lot of local reports prepared separately, you're going to need to make sure that that master file ties in and is consistent with each of those local reports. One of the things we've seen with master file that's been used by some clients effectively is to put it into a PowerPoint format. And what that does for you, we've seen it used in an opening audit conference. And so when a company meets with a local transfer pricing auditor, rather than handing them over this large report, it gives them an opportunity to actually present how the company operates on a global basis and how those intercompany transactions that they're going to read about within the detailed local report tie into the global picture. What we've seen from that is companies have reduced the amount of information requests that they've gotten on audits because they've given the auditor really a big picture view and an understanding of the business before they dig into the detailed report. As far as the size of the master file, I've seen 200-page master files and I've seen 20-slide PowerPoints. I think the general guidance that companies are following is less is more. There are a certain number of required documents that make up the master file, and I think most companies, given that this is going to be given out to multiple jurisdictions of country taxing authorities, have limited really their analysis to just the information that's requested or required by the master file. Okay, local file. We talked about the need for consistency. What we're seeing a lot of companies do is really a centralized approach, where, as I had said in the past, a lot of times local reports were done on a one-by-one basis and not necessarily done in conjunction with one another. I think with this master file, what we're seeing is a more centralized approach, or a modular approach, which I think Paul is going to talk about in some more detail. But if you've got a country where most of your transactions are occurring, what we're seeing is a report prepared. Let's say, for example, we have a U.S. multinational, and a lot of the transactions run through the U.S. We're seeing that U.S. report done first, along with the master file, and then that master file and U.S. report being then used to develop some of the local country reports that may have fewer transactions hitting those local countries. But it's more of a centralized approach and more of a consistent report that comes out. The other thing that I would touch on in the local file is value chain. As I said earlier, China is the only country that I'm aware of that's gone out and made it a requirement to include a value chain analysis. But we are seeing entities put this in place, companies put a value chain as part of their local file, really just to explain, because you've got this CBC now, why the split of profits is appropriate. So it's really kind of anticipating that question from the taxing authority, which is likely coming, and putting that into the documentation. All right, just some practical comments on the country by country and things that we're seeing. So as Ilona said, the threshold to file a country by country report is global revenues of 750 million euros. We are seeing companies that are below that threshold go through the exercise of putting a country by country analysis together. What we're hearing is that even though they're not required to file that, they are using it as a planning tool. It is a good way to kind of line up the statistics on a country by country basis. And they've also been using that as a way to explain their global transfer pricing to financial auditors. The third reason, potentially, for companies to do this that fall under the threshold is I think most practitioners believe in 2020, when the OECD revisits this, and there is a plan to do that as of 2020, that the likely outcome of that will be that the threshold will be lowered. So I think smaller companies are anticipating that and getting ready for that. The other practical consideration that we've seen some companies do is to go ahead and run a country-by-country report 1 year before the filing is required, the filing that is required for this year, and then a year after. And the reason they've been doing that is there is some flexibility on the assumptions that you make in the way that you pull and report the data. But once you report, you need to be consistent. And so what some companies have been doing is looking at those assumptions, looking at that impact over a 3-year basis, as opposed to just looking at the current year and then living with those assumptions going forward. One last comment on country-by-country reporting. There is a section that allows for commentary. We have seen some companies try to go in and analyze and explain some of the unusual things that may be occurring within the country-by-country report. We've been advising companies really to limit their comments to the assumptions that are made, so explaining the assumptions that have been made and trying to anticipate questions from the taxing authorities on any issues within the country-by-country reporting. We think probably is best put into the local files, just because this information is going out to multiple taxing authorities, and those questions may be specific to a certain jurisdiction.
Okay, thank you very much for that, Mark. I can just ask a few questions just before we move on to the third session. You talked there about value chain analyses, and I was interested to look at the results of our polling question that came up around how many companies have carried out a value chain analysis. And I think it was roughly half and half in terms of number of companies that have either carried one out or are in progress versus the ones that haven't yet carried out a value chain analysis. Can I just ask, from a US perspective, in your experience, how common is it for US multinationals to prepare a separate value chain analysis, and what do you think is the main driver for those that are doing it?
Yeah, I'm just looking at the polling. I think that's consistent with what we've seen from polls in the U.S. Actually, maybe a little bit lower in the number of U.S. companies that have done a value chain. I think that comes from the fact that it's not required specifically as part of the local file. Where we are seeing it, I think, is probably a recognition that even though I may be a U.S. multinational, I'm going to have to file local documentation in multiple countries. And in some of those jurisdictions, that value chain analysis is going to be questioned. And so go ahead and get it in there as opposed to dealing with it under audit.
Okay.
Are you seeing different, I guess, in Europe? Are you seeing kind of a different view on value chain?
Well, I think it's similar in terms of the percentage of companies that are required to produce country-by-country reporting as to whether or not they are creating separate value chain analyses for their master file, local file documentation. I think one of the interesting things that I'm seeing, and Paul and I have seen a couple of examples of this recently in Europe. In fact, there's one, Mark, that you and I have been working on where there's different uses being put to the value chain analysis. Perhaps if I could just spend a couple of minutes just talking about those. One of them is a private equity-backed business, which is coming up for sale. And one of the things with private equity-backed businesses is that when they are sold, obviously they don't like there to be any price chipping on the sale. Transfer pricing is always a slightly grey area. There's never a right answer. And therefore, transfer pricing often comes up in due diligence as an area that people look into. And what we've seen in the UK is some private equity-backed businesses carry out a separate value chain analysis as part of the pre-sale vendor due diligence, just to support the end result that the transfer pricing policies have come up with. So obviously, even if a company has gone through a transfer pricing exercise and come up with some transfer pricing policies, it may not be the case that the end resulting allocation of profits is in line with where the value is being created in the group. And therefore, having that top-down approach that the value chain analysis provides can be quite a useful extra way of demonstrating that the profits are in fact aligned with where the value is being created. And even though there may be some greyness around the edges of the transfer pricing, fundamentally the transfer pricing isn't wrong, and therefore there is very little opportunity for price chipping. So that's one of the areas we've seen the value chain analysis being used. I think the other one is more the one that Mark, you and I have been involved in recently, where we've had a group that just feels that the transfer pricing isn't producing the right allocation of profits. But what they've been doing is they've been looking at specific costs and trying to recharge specific costs from one country to another within the group, being struggled to identify all the costs that can be recharged. But when we did the value chain analysis, it gave us justification for a slightly different approach, whereby we were able to come up with a methodology of recharging more costs, or, well, putting in an extra recharge, in this case from the UK to the US, to justify more profits being attributed to the UK where more of the value-creating activities was taking place. So I think there will be increasing use of value chain analyses for a variety of different purposes.
Yep. So
just moving on to the use of country-by-country reporting, and recent guidance we've had from the OECD is emphasising the fact that country-by-country reports should mainly be used as a risk assessment tool for tax authorities. It's interested, Mark, to what extent you are fearful that tax authorities will go beyond using it as a risk assessment tool, and the country-by-country reports will move us more to some kind of expectation about profits being aligned with simple metrics that are reported in the country-by-country reports, such as headcount in each country. Is that a concern that you're hearing about?
Yeah, I think there is a lot of concern out there, and probably most focused on a smaller country that maybe has limited transfer pricing resources trained up, and so a country that's going to basically then use that data. You mentioned headcount, so just use headcount and apply that to global profits as a way to roughly kind of split that out without any consideration of what arm's length pricing should be. So I think the OECD has come out and within its guidance warned that the country-by-country reporting is not to be used for that. But in spite of that warning, I think there still remains concern that may be the way that smaller taxing authorities come up with potential transfer pricing adjustments.
Yeah, that's certainly something we're hearing in the UK as well from a lot of multinationals based over here. And you mentioned earlier on about country-by-country reporting and the review of this in 2020 and an expectation that perhaps the threshold for country-by-country reporting will come down. Have you heard anything about the possibility of additional information being provided in the country-by-country reporting returns that are being made?
I don't think we've heard that, and there's not been any specifics that threshold, a certain amount that the threshold would be lowered to. I think it's just a kind of general thinking that once they do that review, they'll pull more companies in at a lower threshold. I think there was some concern about taxing authorities being able to digest this data, and I think a lot of the writing out there about the IRS in the U.S. And part of the reason they've had to delay when their country-by-country data was due was the fact that they just certainly weren't simply ready to handle that data, and so they had to delay that date. So I think there is concern that we can require so much information coming in these taxing authorities, they won't be able to do anything with it.
Yeah, and certainly it's something we are hearing about in the UK, that the UK tax authority are hinting that they may be looking for additional information being provided in the future, but I guess we'll just have to wait and see on that one.
Yeah.
So looking at the master file, local file format, certainly from a European perspective, we are busy going around converting everyone's transfer pricing documentation into the new master file, local file formats, irrespective of whether or not they need to do country-by-country reporting. But one thing I'm conscious of is that it's not a formal requirement in the US that you follow that master file, local file format. So for example, overseas, European parented groups that have operations in the US, is that format something that you'd recommend, Mark? And are there any things that groups based outside the US need to worry about when reporting their transfer pricing in the US?
Yeah, you're correct. I think the IRS view on that is that the U.S. documentation requirements, as they're set up under 6662, really, I think their view is that picks up the majority of the information that's required in a master file and local file. But what we are telling both our U.S. parenting companies that have operations abroad as well as inbound, foreign multinational parents, is to do the master file. It's going to be required in jurisdictions outside of the U.S. So it's something that needs to be done and needs to be done in coordination with the U.S. documentation.
Okay. And just final question before we move on to Paul. Local files, obviously if a group has got operations in many countries, it would be quite onerous for them to complete local files for every single country where they operate. Is this mandatory? And if not, what are we seeing people do in practice about that?
Yeah, I think in practice what we're seeing is companies do a risk assessment. So looking at all the countries where they have documentation requirements, looking at the size and complexity of those transactions, the documentation requirements in place, how aggressive and active those taxing authorities are in auditing the documentation, and then tiering them, their countries that have those requirements into tiers of most risky to least risky, and doing them kind of more in a tiered or staggered approach. I think with some of the lesser risky countries, we've seen templates, local country templates that can be used that are not as robust as looking at a single country on their specific rules.
Okay, thank you very much for that. We're going to move on to Paul now, where we are going to take a look at the management of transfer pricing compliance, and in particular an area that I think is growing a lot and is going to continue to grow, the use of technology to help with that management of transfer pricing compliance. So, Paul, over to you.
Great. Thanks, Malcolm. Hello, everybody. So, a few slides to talk us through the management of transfer pricing compliance. You may be questioning, well, why is it that we're raising this as a topic now? Haven't we always had to manage transfer pricing compliance? Well, I think the reality is that the compliance elements of transfer pricing have come into sharp focus following BEPS. So you will have heard earlier on in this webinar that the documentation requirements are increasing in terms of master and local file. We are seeing that there is a significant volume additionally of local disclosures that relates to transfer pricing. There is country-by-country reporting, both the notification that a filing will be made, but also the filing itself. So the volume is increasing and the complexity is increasing, and the consequences for failing to meet the obligations are on the rise as well. We're seeing more penalties being introduced for compliance failures. So against that backdrop, we think that there are really three key elements to compliance management. There is the clarity on local requirements and filing deadlines. So these will be different in every territory. The OECD, as part of BEPS, did not agree a minimum standard for local file and master file, whereas they did for country-by-country reporting, which has meant there has been a range of implementation measures by local tax authorities, and the aim is to converge around the common approach for master file and local file. So that means that there is a great deal of variability in terms of local requirements and deadlines. The second element is then the specified workflows, the clarity around the workflows to enable those local requirements to be met. So transfer pricing within an organisation will often require input from more than one team. It will require a sequencing of events to need to take place in a certain way at a certain time. And when you have a volume and complexity of obligations to meet and a number of teams or a number of people who will need to interact to meet that, the workflow can get complex very quickly. So clarity around workflows is very important. The third key element of compliance management is the managing of data, both in terms of who has access to that data, but also how it is that you store the documentation that you will create as part of your transfer pricing compliance processes. I'll talk about each of those in some more detail shortly, but to raise at this point then the question, so does all of that mean that technology-based management is inevitable? And by technology-based, I mean something above and beyond the usual tools that we will use in our everyday work life, so Excel, email. Is there something specific that will need to be used to keep all of this manageable? So if we have a closer look at the local requirements and filing deadlines, this would be a very much longer webinar if we tried to go into the detail of the individual obligations in a territory, but we can see from our view across a range of territories and rules that there are typically four main types of filing obligation. So the first type will be disclosures, often in the corporate income tax return, that an entity has entered into an intra-group transaction. So this is distinct from transfer pricing documentation, which is often designed to support the arm's length nature of the transaction. And this disclosure is simply to disclose that that transaction exists, which is a way for the tax authority to understand, well, what transfer pricing transactions are taking place, and to give them information as to whether they would want to audit that. The second and perhaps most familiar form of local requirement is that of transfer pricing documentation itself, which supports the arm's length nature of transactions being entered into. So as we heard from Mark, the nature of the OECD requirements and recommendations around that have changed to move to a master and local file structure, and we're seeing that that has increased the volume of documentation that a group may be required to maintain, particularly in light of a local file ostensibly being per entity per year. Now, what we do see commonly with tax authorities is a model where they look to get the best of both worlds, if you like. So a stipulation that in order to be effective, transfer pricing documentation has to exist at a specified point in time, usually contemporaneous with the filing of the corporate income tax return, but to prevent them from being deluged by documentation that may or may not be interested in inquiring into further, they will often have a rule that states it needs to exist, but you will submit it to us upon request within a specified time frame. That as a mechanism has existed for some time, but what we have seen is a shortening of the window across many territories between request and submission. And it can vary significantly, but in some territories it may be a week or less than a week, in others 30, 60, 90 days. It's different per territory. There is no common standard, but the mechanism is relatively commonplace itself. So that has some very important consequences for group policy, and we'll talk about that in a few moments' time. The third type of local requirement is country-by-country reporting notification. So this is notification that a country-by-country report is to be filed, and that notification will usually, and it is dependent on the territory, it will usually contain details as to who it is that will be making the filing, either the entity itself or by another member of the group on behalf of that entity. The form and specification of that notification will differ per territory. The fourth local requirement that we will commonly see is the country-by-country report itself and the filing of that report. Now, in the UK, we're heading towards the 31st December 2017 deadline for the first country-by-country report. And one thing that's becoming clear is that the process of XML tagging the file is something that needs time and attention to get right. This won't be the same for every territory, but in many territories there will be the requirement to upload a tagged file, which will then be automatically exchanged with the right tax authorities. There's a couple of very important pieces buried within that. So first, the country-by-country reporting table in summary form in the BEPS Action 13 report does not contain all of the detailed data that you will need to provide, and that detail is buried in the XML schema issued by the OECD, and in the UK that has been mirrored by the UK Tax Authority. So notably, in addition to the summarised information, there will also need to be tax identification numbers of each entity within a group, and if you have a number of entities, clearly there's an exercise there to make sure all of that is gathered. The second important point, I think, is to leave enough time ahead of the filing deadline to ensure that the data that you have is able to be uploaded into the tagging software or the tagging service that you may use, and the structure of the XML schema means it's not necessarily as simple as uploading an Excel version of tables 1, 2, and 3. There is additional information and a certain way that that will need to be structured. So those are the 4 main local requirements that we're seeing. And in response to that, we are seeing and really recommending that there be specification of the workflows to get you to those requirements. So I've just talked about 4 main types of local requirements and has made the point that it will differ per territory. So when you multiply out those requirements which differ across your group, if you have 10, 20, 40, 50 territories, you can see that that very quickly becomes a complex exercise in making sure the right thing is done at the right time. And many of the processes relating to transfer pricing compliance can span years. So you may have a position where the compliance process in year 2 is different from year 1 and different in year 3. And I made that comment by reference to, well, how often is it should you review and update a policy versus an in-between period where you simply update transactional data. So it's not even that the process is the same every year, it will change year on year. So that workflow design will help you be clear on what needs to be done when, but it can also help shape policy decisions on how it is that you will approach some important questions of transfer pricing compliance. So if I refer back for a moment to the question I raised around, well, what happens when you have a tax authority's approach being you provide documentation when it's requested of you? You have a policy decision there. So do you create documentation for the deadline, or do you adopt a policy that you will create and provide it when you have been asked for it? And of those 2 policy decisions, you will have very different workflows resulting from that. And so the working out, well, how is it that we would do it in either of those cases can really help shape which of those is viable for us, and to then focus the mind and focus the efforts on, well, how do we make sure that whichever policy you adopt, we can make it happen on time. We're also seeing, certainly in the UK, this is a definite development, the management of tax tending towards a greater focus on the attitude, governance and processes that relate to tax as a whole, rather than necessarily a focus on individual issues. So workflows is one very important aspect. The other side of that, and related to that, is what you do with the data that you will generate as part of your compliance efforts. Now, transfer pricing can produce sensitive data, and it can be sensitive for an internal perspective. So it may be that there is information on the performance of a business unit, which will be sensitive with reference to other business units. And it may be that information is created which is sensitive across territories, and that a perspective of one territory may have a bearing on another, which tax authority would be very interested in. One of the consequences, I'm sure you've all seen, of transfer pricing analysis is it can produce a wealth of documentation, and there is often need to manage and organise that documentation and store it in a way that can then be accessed often many years after the fiscal year in question if it is subject to audit. The master and local file approach that Mark was talking about earlier, and particularly where a modular approach is adopted, means that you will often have different types of transfer pricing data, and there is a question of how it is that you establish how that should be created and controlled, who should have access to what data, and it responds well to the mapping out of this is the type of data we will create, and this is how we will allow access to it and then store it. And so that tees up the question of, well, is technology-based management inevitable? And the answer is, well, it depends. And it depends on a number of factors, I think. So the size and complexity of the business, how much resource you may have, the budget that you have, the nature of existing technology support. And there isn't one silver technology bullet. There are a number of solutions, vendors, providers who use vendor software solutions, but we see that it will gather into document creation software, so how you create a document using the tool itself. For country-by-country reporting, how data can be gathered, and then how it is that reports can be lodged, i.e. tagged with the XML schema and then interface with the government's online scheme, if that's how it's to be lodged. And then finally, workflow management and document storage. And so there is no one-size-fits-all on this. There are a range of options, and I think the right fit is the right answer. So it's not a definite yes, but it is most certainly something that I think groups are increasingly considering before they lock in their approach to compliance.
Okay. Well, thank you very much, Paul, for that. I think it is definitely going to be an area of increased focus and attention by many multinationals. Interesting to see on our polling question there that over half of you are currently considering the use of technology to manage your transfer pricing. So we have come to the end of our allotted time. We have had a few questions as we've been going through, which we have responded to. For those of you who haven't had a response, we will send you a response shortly by email. So thank you all very much for dialing in. Thank you very much to our three presenters, Ilona Orbach from Hungary, Mark Schutte from the US, and Paul Daly from the UK. Our next webinar in the quarterly series is on Thursday, the 30th of November, where we will be taking a look at the latest developments on Brexit and the tax implications that arise from Brexit. So I look forward to welcoming you all then. Thank you very much, everyone.